If you have a superstar on your team, it's worth investing in them. If Marla and Derrick are that superstar team, paying up is never a bad idea. If you could buy a company like North Shore Climate Services at a 10 times deal, and in 1 year, because of the skill and capability of your team, turn into a 6 times deal, why not? People buy on the come all the time in private equity, especially when growth capital is the discussion point.
In this episode, we're breaking down how private equity teams decide when to buy, when to build, and what separates a bold move from a bad one. Welcome back to As the Deal Turns, where we track the life cycle of Iron Air, a Chicago HVAC contractor. In our last episode, Iron Air was acquired by private equity firm Monroe Family Capital. 1 year later, the team is thinking bigger, a bolt-on acquisition of a North Shore competitor. But a much larger player wants the same company. The decision? Buy versus build, and the discipline to walk away at the wrong price. Bolt-ons look clean on slides. In the field, they live or die on calendars, contracts, and conviction.
North Shore Climate Services is in play. Evan Park's shop, best brand up here. Stronger than Iron Air on the shore. Great accounts. I know the customers. I know him.
What's the number?
An arm and a leg. Banker says top of market, and honestly, he might get it. Hospitality and municipal renew if you show up.
If a rival buys him, we're shut out. That kills the North Shore vector and puts our roll-up thesis at risk.
The prize wasn't just revenue. It was the door into a market. Miss it, and Iron Air's future narrowed overnight.
It's probably worth mentioning that in episode 1, we learned about the strategy, the acquisition strategy of Monroe Family Capital, which was to take a business that was stagnant and to leverage the capabilities of the team and the brand into something greater. As they're thinking about going to the North Shore of Chicago, they have to decide how to get into that market, obviously. And it looks like one of the major players on the North Shore is for sale. This question of buy versus build is sort of a perennial one in private equity. And depending on how the deal dynamics turn out, it's questionable as to whether or not they should be buying or building. There's always a price where you're interested, and there's always a price where you need to decide to walk away. I'm excited to see where Derrick and Marla and Alex, how they identify that point and whether or not they have the discipline to walk away from the table.
Let's be explicit about stakes. If a competitor takes NCS, can we still stay on plan?
We become reactive, and we would have to move our best people to the North Shore because they already have all the best technicians there. So we would hurt ourselves to grow because we would have to water down our talent. With NCS, we are buying a very talented workforce along with the accounts.
Or we prove we're builders, not buyers. But we need to be honest. The fastest route in is Evan's logo.
We're seeing strong interest. This is a great brand with great accounts and a great workforce. Thanks to NCS's Technical College partnership, Evan's team built something special. Expect high single-digit multiple on current EBITDA with structure around working capital and a performance-based earnout. This is going to be more expensive than your Iron Air purchase.
Evan, our team at Iron Air admires what you've done. We're absolutely interested.
We really focused on developing top techs and a great training program. The accounts followed.
Indeed. What's a clean path for you post-close?
Honestly, that's really up to you. My wife and I will be selling our house here and heading south, but if you want 3 to 6 months, I'm happy to consult. I can transition the key accounts in a month or two.
Nice to see you both again, Derrick and Alex. Best offer by Friday.
Alex, what are you thinking? How aggressive are we going to get?
I am not sure yet. 7 to 9 times. I think there is an argument that we could win some great accounts in Iron Air with the acquisition. What's the ops pinch point?
We have momentum in the West. Don't chase, but I think you expect that we can take price over the next year or two. Figure pricing improves 5 to 10% over year one. They were too aggressive on pricing, especially given their talent.
Price, pride, and practicality. Each true, each incomplete on its own.
Obviously, Alex is getting acquisitive here, 7 to 9 times, definitely getting pretty pricey for an HVAC contractor, but he's trying to rationalize it, right? And he's rationalizing by saying that the purchase is actually going to lift their existing business, because Iron Air itself, on the west side of Chicago. And it might just actually be worth it, given that North Shore Climate Services has developed a pipeline of talent to the local technical college. Let's just put it this way. As an entrepreneur and an operator of a company, the solutions you create actually do build value in such a way that separates you from the crowd. In this particular case, it looks as like North Shore Climate Services has done something unique on the human resources side that's adding value to the business that actually might realistically add value to Iron Air's business. So that does make sense that they'd be willing to pay more. How much more, I guess we'll find out.
Thanks for listening to As the Deal Turns. We'd love to hear from you. If you're an independent sponsor, a private equity investor, or someone who's had experiences inside a deal and want to share your story, we'd love to feature you on the show. We're always looking for storylines and perspectives that bring the human side of private capital to life. If you'd like to join us as a guest, share your experience, or even explore sponsoring the show, reach out at asthedealturns.com. We'd love to connect and keep these conversations going.
Low bid tests the water, but signals uncertainty. Mid gets us in the mix. High wins if the process is real. We need 3 numbers. No regrets, win it, walk away.
We should probably go win it. If we nibble, we lose the deal. The banker already knows us. He knows how we think, and our pricing strategies are already known to him. Our previous relationship is good and bad, I guess. Fewer options, but higher trust.
I think we can get an attractive return at any level. This is really about our company's M&A and growth goals. A combined company probably wins on quality, multiple expansion, and scale. Obviously, getting a deal is attractive, but I'm not sure how much is too much. Our M&A strategy might become a bigger part of our strategy than we might have thought on day one. Have we given any thought to the strategy downside of someone else acquiring NCS? Derrick, what would happen if your old employer got hold of it?
Well, it would make it harder to acquire them for sure. Owning NCS would isolate them.
I appreciate the input. Derrick, let's be aggressive here. Let's talk later. I'll go talk to our credit partner and get their thoughts.
A bid is a story about goals, strategy, and the underlying deal math.
Okay, so I guess a couple of things are being revealed to us now. One is that the business that's for sale could also be of value to some other competitors. That's always a risk when you're in a geographically specific business. I guess that's always a risk and something you have to manage. Of course, if your strategy requires you to be acquisitive, that might end up putting you in a position to pay more. And if the banker you previously worked with on a earlier purchase knows that, then who knows? It's hard to tell whether that's good or bad, as Derrick pointed out. If a banker has worked with me and knows and trusts my ability to execute and the skill at which I acquire companies and or bolt them on, well, that could be a benefit when talking to the investment banker's client or the seller about the buyer, right? I've worked with these people before. They do a really good job. They say they do what they say they're going to do. I mean, that's worth a huge amount at the margin. Sometimes it's just about who's willing to pay the most and whether people are selling their business like a piece of meat or not. If it's truly a commodity, maybe these things don't matter. But most sellers at the margin do care about the promises that are made to them after the deal is closed. And also, the banker probably can push them, given that this is a more attractive asset than apparently Iron Air was.
Quick update. Good afternoon, everyone. Interest is high. Several parties near the top of guidance. If you see this as strategic, you'll want to tighten your terms and improve price. Best and final by EOD tomorrow.
He's played this card before. Sometimes it's theater. Remember when we got baited last a few deals ago, before Iron Air, Alex?
We did lose the deal, though. This one I think is real for all the reasons we discussed earlier. 2 errors available: overpay or miss the door. Which can we live with?
What we can't live with is fear running the model. Reggie ran a route density, and buying NCS will allow us to ramp much more efficiently on the North Shore.
Very interesting. That's probably worth a half a turn.
We can sweeten the price and the structure. Marla and Derrick, are you investing at 8.25 times?
Yes.
Yes.
Before we get too deep into whether or not Marla's interested in buying it, I think it's important to note the value that an investment banker or a broker brings to any transaction, any private sale. We were just talking a minute ago about how knowing the investment banker can be good and bad. You know, sometimes people that own businesses think they can go it alone and sell it themselves. But there's nothing better than managing the uncertainty around a good marketing process. This question as to whether or not the investment banker really does have other interested parties vying for the business is always a question that I think a buyer has. But if a buyer is good at what they do, they know that these assets are valuable and they know that there is a price that someone's willing to pay for them. And the investment banker being a part of that process just validates that. If you think you should sell a business without that type of representation, you're crazy. The brokers, the investment bankers of the world are really, really critically important to getting a deal done, and you need to protect them. You absolutely need to protect them. They're critical to the deal, and they do create a lot of value, and they more than likely pay for themselves in just running a competitive process. If you're thinking about whether you should include an investment banker on your process or not, the answer is certifiably yes.
That's a premium to the 6.5 times we paid for Iron Air going in, but it feels right. We'll need some additional capital from everyone. I think that will get the deal done. Are you guys in?
Yes.
Yes.
It is interesting that Alex asks if Marla and Derrick are in. If you recall from the first episode in this series, they all invested in the deal. And what Alex is doing right here is he's saying, look, you're not just the managers, you're investors in our asset. And if we're going to reach for this one, if you're going to reach for this one and fold it into the company overall, in a way, you're paying up as well. And our blended investment is going to change, albeit at a higher, at a higher price and higher multiple. Alex probably already knows the answer to this. In a way, he's asking him, I'm assuming you're coming in for this next round or this next chunk too. But he's also testing or checking their pulse on his thinking around price, which is interesting dynamic.
A competitive process and an attractive asset have a different calculus for an existing operation. Marla and Derrick are not only responsible for making it work, they are putting money where their mouth is.
We can build relevance up there without buying it, but speed matters. It's slower and cheaper to build it ourselves, but it would take years to get their expertise and footprint. Time kills. We have already grown Iron Air to a 4.5 multiple, blended, and will be less than where we started only a year ago, with a much longer runway.
I'm not hiding this. My comp scales with size. Deals matter to me. But I also think we win if we plant our flag now.
I appreciate the honesty, but you guys have proven that you can make a deal work. We don't have to look too far down the road, and this will have attractive characteristics.
Well, planning ahead, if we lose this bid, we launch an Iron Air North Shore the next day. We stand up SLAs first, and we win business on cadence. We'll force NCS to win the business again. Give me the runway. I will get you relevance.
I appreciate the effort, guys. Let's see where we end up. I like the options either way.
Okay, so that's exactly what you want your operator to say. Don't worry if we don't get the deal. I'll make it up. I can go build this thing tomorrow. I mean, that's exactly the right attitude that creates a healthy tension in buy versus build. Though Marla and Derrick both identify the fact that time is of the essence. And the last thing they want to do is be up against a stronger competitor that's now been recapitalized and refinanced by a new acquirer that's not them. So sure, could Marla do it? Could she build Iron Air into the North Shore? Absolutely. Could they recreate sort of the technical skill and capabilities? Sure. But what for? I mean, this is the beauty of private equity at work. Let's go buy another company, let's bolt it on and start scaling even faster.
Ambition, discipline, execution. 3 truths, one decision.
I'm just off the phone with the banker. They want 9 times. We reconvene tomorrow morning. No rush decisions tonight.
So what you see here is a traditional private equity strategy. Buy a platform and then build it through bolt-ons. There's absolutely nothing wrong with that. And it makes a lot of sense. This is not something that an individual does well, in the sense that the original owner, Jerry's family's entire net worth was tied up in Iron Air. And he could have hypothetically leveraged the business and started bolting on acquisitions himself. But every time he did it, he would be putting the entire family's net worth at risk with immense concentration. That's why private equity exists. Really, a roll-up of these businesses should probably have happened, but it requires someone with a broader purview and a diversification strategy that Jerry's family just couldn't have done themselves. So here we've got Iron Air, owned by now Monroe Family Capital, driven by Derrick and operated by Marla, bolting on other opportunities, other markets through capital and through operational rigor. Jerry was not ready to do that, but it's exactly what Iron Air needed.
Do they raise the bid and take the North Shore prize, locking in route density in a brand the market already trusts? Or do they step back, bet on Marla's slower, cheaper build, and prove Iron Air is a company that makes markets, not just buys them?
Adding on to that, the bidding strategy related to this bolt-on, it's not surprising that it's a competitive process, especially when you hire an investment banker. That's their job. They know who the logical buyers are, and they're going to drive price through that process. That's when you know you have a good banker. There's a market clearing price that needs to be found. Investment banker's job is to find that market clearing price. It appears as though that's what's happening here. There's always a time and place to bid up an asset, especially if it's going to be of strategic value to your existing business. It's hard to be a financial buyer sometimes because you're stepping in to buy the platform for the first time. You don't have a strategic reason to be buying that platform except for what comes next. Monroe Family Capital got in pretty cheap on this. So I think they did a 6.5 times deal for Iron Air and basically bought the infrastructure that now allows them to reach a little bit further. We didn't talk about this earlier, but Marla took the 6.5 times deal through operations with Derrick's help down to 4.5 times. And I believe that business is a bit bigger. I think 15 million, if my memory serves. This is a deal for $6 million business. So even if they pay 9 times, the blended purchase price for now these two businesses, which I think are actually very complementary, are probably somewhere around 6.5 times again, maybe 6 times, just doing it off the top of my head. That's not too much to pay for a really good business. And if it's a stronger and better business now because of the North Shore acquisition, I think that's probably worth doing. I think it's the right play, especially given the size of the business and how complementary that business is to Iron Air's existing business on the west side.
If your portco is behind on initiatives, drowning in backlogs, or your team's stuck filling gaps themselves, this is your fix. Kayana embeds PE-literate remote professionals, trained, AI-ready, and scoped for impact. Close your books faster, clean up CRM, tighten order to cash, all without adding payroll. Built by a former PE-backed operator, Kayana moves at your pace. No drama, no dead weight. Get the talent that ships. Preview how it works at hirekayana.com.
The future of Iron Air's strategy and its identity waits one night. Next time, years pass, the scoreboard changes, and the exit clock starts. Who wants out? Who doubles down? And what happens when Marla plays golf with some old friends? Maybe she sees more opportunity. Find out in the next episode of As the Deal Turns.